Hi, Penelope. Going to hit record. I'm going to grab my PowerPoint and we're going to chat about chapter 9. If you have any questions as we're going through, just let me know. I'm not sure if I have this on my flash or not. I might have to run out to the internet and get it. We'll get rolling. Here, and then I'll share my screen. Sorry, I should have had this up and ready to roll. I was looking outside this morning at the neighbor's yard and I'm like, what is that white? It looks like a pile of snow. And then the other neighbor had it in their yard. So that's kind of distracted me this morning. And then I said to my husband, that's garbage. Must have had a bear in our yard because we have our garbage in a container, like a thing that opens up, a storage bin. And I said, it looks like the bear opened up, but he couldn't get to the garbage can. Smart bears, which we have seen bears in our yard. So they're out looking for food. Okay. Back to my sharing. And now I'm going to share my PowerPoint. So you should see that. Let me go to the slideshow. Swamp out the display so you can see full view. And I want to go to okay. All right, so this is where we're starting. We have looked at so far in chapter 9 business gross income and the characteristics of deductible expenses. And then we looked at some specific expenses, can't deduct at all, some that are partially, maybe limited, okay? And we always remember, no matter what, any business deduction expense we take needs to be ordinary, necessary, and reasonable. Now, the next part of our chapter gets a little squirrely, to say the least. And it has to do with our accounting methods that we choose. So first of all, before we pick cash method or accrual method or what we call a hybrid method for our tax return, we have to determine our accounting period. So most tax years will be a full tax year, at least 12 months long. We talked about already, sometimes a company could have a short tax year, maybe when they first start, or if they switch from one tax year to another tax year, that time in between when they're switching from the old to the new would be considered a short tax year. You still need to do a tax return for that. So we just want to let you know that. Most companies, when their year ends on December 31st, we'll call that a calendar year. And then there's companies who may not end on December. We call those fiscal years. Now, how do we choose an accounting period for our business? And this is tax law. Proprietorship. So a sole proprietorship business has to have the same tax year as the proprietor, the taxpayer. So if the company wants to have a July 1 through June 30th tax year, the sole proprietor has to change their tax year to that same year. So they can't have different years. C corporations and individuals choose, they make a choice. So C corporations are non-S corporations. And they make that on their first tax return, and it is consistent with how they do their financial statements, their book accounting period. The other type of entity for taxes, remember, are partnerships and S corporations. And it gets a little bit more complicated when it comes to those types of entities, because now you have more than one owner and the income is flowing through to their tax return. Sole proprietor is pretty straightforward. One owner, just make them the same thing. But what if you have 2 or 3 or 4 partners? 2 of the partners have a calendar year, and one of the the 2 other partners go July 1 through June 30th. Now we have to take a look at the tax rules. We're not going to get into all of the rules here. We just want you to know it's usually the majority owners, they'll have the same, the company, the S corporation or the partnership will have the same accounting period as the majority of the owners. It could get a little bit more complicated than that. So we just want to bring this awareness to you. We're working in proprietors, so that's all we're worried about right now. But we do want you to know about those other types of entities and how it could get complicated with partnerships and S corporations. Okay, so that's accounting period for your tax return. So in a sole proprietor world, single member LLC world, whatever the taxpayer's tax year is, that's your business. Now, what about the type of accounting? So remember, we have financial, which is GAAP. So remember here in our first bullet, when we're making a financial statement, so the accounting, we do to make a financial statement, we follow the rules, generally accepted accounting principles. And normally in this accounting, when we're focused on making a financial statement, we're looking to show as much income as possible and as few deductions as possible in a year, because we focus on net income. We want the highest net income. However, for tax purposes, it's opposite. Okay, we try to choose an accounting method because now we have choices: cash, accrual, or a hybrid, which we're going to focus on cash and accrual, the 2 major ones. Now we could pick the method that will help us not show as much income and accelerate our deductions, because we want the lowest profit on our tax return. So 2 different ends have 2 different approaches. So what are our permissible methods to choose from? Well, we have cash, and we already talked about when you can use cash accounting. And you can see right in here, the methods are adopted on your first tax return. Now, cash, we recognize income when we receive it. Okay, so there's no unearned revenue here. Okay, you get the cash, whether you did the service or not, you show that on your tax return. And remember, sometimes we don't have to have the cash in our hand as long as it's constructively received. So we had access to it and there was no restrictions on it. You show that on the tax return in the year it's constructively received. We talked about that already. The accrual basis says, oh no, recognize income when earned or received. Oh, wait a second. So in our financial accounting, we recognize income when it's earned. So if we get money early from a customer, we don't show it as income until it's actually earned. In taxes, it says, oh, you show it in income when you earned it or received it, whichever's first. A little different. Now, the hybrid method you have to choose from gives us a mixture of both cash and accrual. Cash and accrual, there's enough rules related to those that we're not even dealing with hybrid, okay? But you do adopt it on your first tax return. Take note, large corporations and partnerships, I just want to make sure of something. Large corporations and partnerships generally, and with partnerships with corporate partners. So that means a corporation is a partner in the partnership, which does occur. they must use accrual accounting. And it's a gross receipts test that will allow you to use the cash method, which we already talked about in the beginning of the chapter. So we're going to go over some of the major characteristics, pros and cons of each method. So let's take a look at cash method. Income is recognized when actually or constructively received. We just talked about that. Expenses are generally recognized. I'm using the word generally because we're going to have some exceptions, but they're generally recognized when paid. Now, what are the pros and cons? It's a flexible method. It's pretty simple and inexpensive to use, but it doesn't match income and expenses like we do in our financial statements. Remember, our approach and accrual for our financial statements is based on activity. When did we earn the revenue? When did the expense actually occur? And we match them together. That's not what happens with the cash method. It's purely looking at cash in your transaction. Most, if not all, small businesses use the cash method. But we have the accrual. We need to be familiar with it for tax purposes. So let's take a few minutes and talk about when do we recognize income under the accrual method. Now, back in our financial statement, it's generally when we earned it, but not so for taxes. Income is recognized when earned or received. There's something called the all events test that will determine if you must recognize income. And this is what it says. When all the events have occurred that fix the right to receive that income, that's when you recognize it. And you can reasonably determine that amount. So if you're like, well, what the heck is that? It's the earliest of these dates. When the service or sale is complete. So that's our general rule, right? In financial accounting, when we earned it. Not in taxes though. When the payment is due. So whether they pay it or not, when it's due, it should be recognized in income. Or when the payment is received. So we look at these three dates and we say, which is the earliest? That's when we recognize the income for accrual method in taxes. Just a little different than what we're used to under what we call accrual in financial accounting. So take a look here. Ben provides consulting services and bills ACE for $12,000. ACE disputes the amount, claiming that $8,000 is the proper amount. How much income should Ben recognize under the accrual method? Well, let's go back one. It says, recognize income when all the events have occurred that fix the right to receive it. Well, Ben performed the service. He obviously did all the things he needed to do. Report the amount that can be determined with reasonable accuracy. Well, since they're disputing some of this, the appropriate amount will be $8,000, not the 12, but the 8,000. Now, if you receive and you handled the dispute in the future and get the additional 4,000, well, you'll recognize it then. But as of today, the accurate amount is $8,000. Because that's what ACE is agreeing to pay. Let me full income. Let's see if I want to show you another example here. Okay, let's see. Let's go to the next slide. Here we go. What happened? Let's back up 1 second. When you're a cash method accounting for taxes and you receive money from a customer early, show it in income when you receive it. What about an accrual? Well, the general rule says show it when the first date you receive it, you perform the service, or it's due, whatever's the earliest date. However, there is a little exception. Okay. So you are allowed to defer recognition for 1 year. So even though you received the cash in 2020, you may be able to defer or not show that in your income in 2021. Unless the income is already earned or recognized in your financial records. This little exception does not relate to the prepayment of rent or interest. So if you're an accrual basis taxpayer and you receive money early for rent or interest, show it in the year it's received, even though you're an accrual method taxpayer. Take a look. Ben provides dancing lessons. On September 30th of this year, he received $2,400 full payment for a 2-year service contract. What amount must Ben recognize? If he is a cash method taxpayer, $2,400. What if he's an accrual? Now think about this, and I'm just going to pop out of this slide a second and go to a Word document, and I'll share that screen with you. So we could see the accrual method in action. So, oh, come on, where's all my... Tell me if you can't see that. Let me make sure you can see it. And there we go. Okay. So Ben receives cash. Let's say it's in 2020. $2,400. I just want to make sure I have $2,400 on September 30th for 2 years of dance lessons. Okay, so the assumption is he starts giving the dance lessons during October. So under normal GAAP accrual, 2020, the company will show, so 2,400 divided by 24 months equals $100 a month of income. 3 months is earned, so he provides the dance lessons, October, November, and December. Oops. $300. In 2021, when he provides 12 months, right, because there's 12 months, he'll recognize $1,200 in income. Then under 2022, when he completes the remaining 9 months of the 24-month contract, he will recognize $900 in income. So this is the amount that will be shown in income each year. But remember, this is normal accrual for our financial statements. That's not what tax does. Here's what tax says. At $2,400, okay, we'll let you defer some of it till next year. Some of it you could show in this year, but then you're going to show the rest of it next year. So accrual method for tax says this. In 2020, whatever the guy's name was, you show the part you actually earned. So he earned $100 a month times 3 months, $300. In 2021, show the remaining amount, in income. So you could defer the part that you didn't earn this year to next year. And even though you didn't earn it all by the end of next year, that's the rule. So they give you a little bit of a break. Now remember, that's your objective. I'm not trying to show income this year. Push it off to next year if I can, especially if there's a chance tax rates could change. Okay, so we try to do that. So on page 919, we have a couple more examples of this. And this one deals with Rick. In late November 2020, Rick received a $7,200 payment in advance from a client for a monthly landscaping service. He's going to do it from December 1st, 2020 through November 30th, 2022. So he's going to be doing it 2020, 2021, and 2022. Under the accrual method, if Rick elects the deferral method, he would recognize $300 of the income of that $7,200 in 2020 because he earned 1 month of it, December's. He would then recognize the remaining $6,900 in 2021. Okay, in the example next down below, it says, suppose that rather than receiving payment in advance for services, Rick's client paid $7,200 for landscaping supplies, which is a product that Rick purchased and provided in 2021. When must Rick recognize the income from the advance payment for goods? So this is important because he is allowed to defer all of that $7,200 to next year because that's when he provided the supplies. So the little snafu when it comes to accrual basis and showing income. General rule, one more time. Let me go back to my slides. So the general rule says, I'm just going to stay in here. The earliest of when you perform the service, you receive the cash or it's due. You can elect, though, to defer. Oops, where was that? Here it is. Defer some of the income that isn't earned as of the end of the current year when you received it to next year. You don't have to, but you're given that election. Any questions? All right. Go. Okay. That's what I was just talking about. Okay. So we're just going to kind of fly over inventories a little bit. We don't really deal with it in our chapter for anything other than maybe some graded problem, nothing on our tax return, but inventories must generally be accounted for under the accrual method, even if you're cash method. If sales of your goods is an income producing factor. So yeah, you have to sell goods to make money, then you have to account for inventory. You don't expense it or deduct it as you buy it. You will deduct it as you sell it. So sales and purchases must be recorded using the accrual method. taxpayers who qualify under the gross receipts test can opt to treat some purchases of goods for sale as non-incidental materials, so they could just expense them. But you got to meet a gross receipts test. Let's see if I can find that quick. I don't know it off the top of my head. No, I don't even think they mentioned. Let me see. Why that 26 million? Okay, so we just want to bring that up, that you can, if you meet certain gross income limits, treat them as an expense when you buy them. But generally, they are deducted when you sell them, not when you buy them. Not worry about UNICAP. That's a little bit beyond our scope. What we do want to talk about is how you can remove inventory. This takes us back to financial accounting. So companies can remove inventory for tax purposes under first in, first out. So as they sell inventory, they remove it and deduct it, the cost of it. They also can use last in, first out, which is really a method that was developed by Congress for tax purposes. And financial accounting, we just say, well, they do it for taxes, let's let them do it for financial statements. If you use LIFO, last in, first out, so now you're expensing the newest assets or inventory items when they're sold, then you must use that for financial statements. So you have to use them for both. This method normally generates or allows for the highest inventory deduction. Or you can use specific identification. And that's when you go, wow, this coffee cup, this particular coffee cup, I know when I bought this to sell in my company, I paid $3 for it. So when I sell this coffee cup, I'm going to take it out of inventory at $3. Now, if we sell 3,000 of these coffee cups, okay, we're not going to know how much this coffee cup cost us because we don't have a specific identification number that our computer could recognize for this coffee cup. We just don't have the technology here, or we don't use it yet. But if I bought 10 of these to sell, I could track them. And that's what specific identification is. So you have 3 methods generally to choose from to remove your inventory, the amount you can deduct as you sell it on your tax return. And they do some demonstrations of that. I just want to bring that to your attention. Let's get into the other fun stuff. Accruing business expenses. So we looked at when do we recognize income, but when can we deduct expenses that are normal, ordinary, and necessary to our business? All right, so the accrual, back up, cash method went generally when you pay it. Now there is a little exception there, but generally when you pay it, we'll talk about that. What about the accrual basis? Remember, accrual, we don't record expenses when we pay for them. We record expenses as the activities occur. We received utilities for December. Well, that's an expense in December, even though we don't pay it till January. So the question comes, when can we record an expense under the accrual method for taxes? And there's 2 tests that must be met. The first is the all events test. And the all events test basically says all events, everything has occurred to establish that you owe that money. And you can reasonably determine it. We do no estimating. We do not estimate liabilities or expenses. So you're going to see, we don't do any bad debt estimating in tax accounting. Nope. So it's pretty much, you know, you owe this money and you know about how much you owe. You could determine it pretty reasonably. The other major component is something called economic performance has occurred. And this we have to dive into a little bit more. Okay, so this economic performance rule really is focused on accrual method taxpayers. So these are just separate rules that guide you as to when economic performance occurs, when you're an accrual method taxpayer, and this defines when you can deduct an expense. So let's take a look at that. Go to page 9-24. So top of the page says, well, economic performance test differs based on what kind of deduction you're trying to take. So we have separate rules for different types of deductions. So here's the rules. They categorize them as, first one, and I know our slide might be different, a little bit different than what we're looking at, but I like to take the next 2 pages, and we basically read the next 2 pages together so you know what they are. The company is going to receive goods and or services from another person. So when a business receives goods or services from another, the business deducts the expense associated with receiving them when the other person provides the goods or services. Now, take a look at example 9-22. On December 15th, Rick contracts with your new fence company. So Rick is the company, the landscaping company. He goes out to another company called your new fence company. He's asking them to repair a concrete wall for one of his clients because he doesn't do that kind of work. So he goes out, contracts with another company. When he does that, he gives them $1,000 as a down payment. So the customer isn't paying your new fence company, Rick is. So Rick says, hey, I'm charging my customer for fixing the wall and doing the landscaping and all that stuff, but I need you to do this little part. So he goes out and he gives your new fence company $1,000. And he agrees to pay $7,000 more when your new fence company finishes. So since Rick is paying this is an expense to Rick to complete this job over here and get income. The question becomes, when does Rick get to deduct that $8,000 he's going to pay? So it depends. When did the company receive the goods or services? So when did Rick actually receive the service from your new fence company? So we got to keep reading. YNF was not going to start working on the wall until next year. So as of the end of the year, Rick has not billed his client for the wall because no work has been done. Rick expects YNF, your new fence company, to actually finish the repairs by April of next year. How much of that $1,000 can he deduct in 2020? And how much can he deduct in 2021? Well, under the accrual method, Rick cannot deduct anything, even though he paid $1,000 of it, until that fence is done or that wall is done. So Rick will deduct the full $8,000 in 2021 when the repairs are done, because that's when economic performance occurs, when you're receiving goods or services from another person. Now, under the cash method, if Rick was cash method, this doesn't apply. $1,000 deduction in 2020, $7,000 in 2021, because that's when he paid it. Assume instead that Rick expected YNF to finish the wall by the end of January. There's a little tiny exception here. And here's what it is. Under the accrual method, Rick is allowed to deduct that $1,000 in 2020. So the exception to receiving goods or services from another person is if you expect to receive those within 3.5 months after the payment. So if you expect that work to be complete within 3.5 months, you can deduct it in the year you paid it. Okay, so because Rick is not receiving the service in the first example until April, falls out of that little time period. But since YNF is going to complete that work for Rick by the end of January, now he can deduct the $1,000 he prepaid in 2020 because of that little exception. So we want to make sure you're aware of that. That's why I like going through these examples. Any questions? Okay, next one. What if you're renting, the company is renting or leasing property from another person? So, you know, you prepay your rents. So you are renting from a company and you pay in 2020, 12 months rent in advance. When can you deduct it? When a business enters into an agreement to use property from another person, economic performance occurs over the time of the lease. So normal accrual. So 923. May 1st, Rick paid $7,200 in advance to rent his shop for 12 months. What amount may Rick deduct for rent in 2020, assuming he's the accrual method? You take $600 times the 8 months he used it, and he could deduct the $4,800. On top of 925, take us in a different scenario. So that's accrual, that's it. What if he was cash? We talked about the cash method in the beginning of the chapter. What if we prepaid, I know I'm kind of flopping back from accrual, but what if he prepaid $7,200, $7,200 in May for this? How much can you deduct? Well, we come back to the 12-month rule. So when you're a cash method taxpayer and you prepay an expense, except for interest and rent, I think it was. No, interest, for interest. Doesn't apply there. Can you deduct all $7,200? You're a cash method taxpayer. The rule is, if the contract, so the lease here, is 12 months or less, and you'll receive all the benefits from the contract by the end of the next tax year, you can. So since this was a 12-month lease, and he'll have all of the requirements done by next year, he'll receive all the rental time by the end of 2021, he could show all $7,200 in 2020. So that economic performance doesn't apply to cash method taxpayers. They got their own set of rules. All right. Let's go to the next economic performance, and that is providing goods and services to another person. So when you, the company, are going to provide goods or services, when can you deduct expenses related to that? So a business that's liable for providing goods and services to another meet the economic performance test, so you can take a deduction as they provide those goods or services. So don't get that confused with the first one where we paid for someone to give us a good or service. Here, we're providing the goods or services. Take a look. Example 9-25. Okay. In the summer, Rick landscaped a city park. As part of his service, Rick agreed to remove a fountain from the park at the option of the City Parks Committee. In December, the committee decided to have Rick remove the fountain. Rick began the removal in December and paid an employee $850 on December 31st for working the last 2 weeks of 2020. Rick completed the removal work in the spring of 2021 and paid an employee $685. How much can he deduct? Well, under the accrual method, Rick is allowed to deduct his costs as he provides those services to the city in this case. So Rick can deduct $850 because he was providing the services in 2020, and then the remaining $685 that he pays to the employee in 2021 to provide the goods or service are deducted in 2021. If this was cash method, he would follow the same rule. So you can see accrual method is in plain old accrual method in taxes. We got some crazy exceptions and rules that are really defined. Last one. Payment of liabilities is our last category. Economic performance occurs for certain amounts we owe when the business actually pays it. So incurring payment liabilities are essentially the cash method. So you can't deduct these until you actually pay them. Some examples: workers' compensation, rebates and refunds. Can't deduct those till you actually pay them. Awards, prizes, and jackpots. Insurance, warranties, and service contracts provided to the business. Now, this relates to insurance, warranties, and product service contracts that cover the taxpayer and not a warranty that the taxpayer provides to others. Certain taxes, and there are other liabilities not provided for elsewhere, of course. So, let's take a looky. Let's see what the example is for those. All right. There is an exception. Okay, we did that. We'll come back to that. Middle of page 9-26. One of the most common exceptions to any economic performance is the recurring item exception. Under this exception, accrual method taxpayers can deduct certain expenses even if economic performance has not occurred by the year end. So they give us an exception to all these crazy rules. And basically it says this: if the item is a recurring item, so it's a liability that is expected to keep happening and happening and happening into the future, and it's not a huge dollar amount. It is not material or an amount, or deducting the expense in the current year more properly matches revenues with expenses. You generally can do it. Now, in addition, the all events test must be satisfied at year end, and actual performance, so actual economic performance of the item, must occur within 8.5 months after year end. So this exception does not apply to workers' compensation or tort liability. So there's certain things it just never occurs to. So let's look at some examples here. We can understand what the heck this is. If clients are not completely satisfied with Green Acres Landscaping, Rick offers a $200 refund, no questions asked. So there's a refund. Okay, so that is part of our payment liability. Usually we can't deduct refunds until we pay them. Near the end of 2020, Rick had 4 clients request refunds. Rick incurred the liability for the refunds this year. However, he was so busy with the holiday season, he didn't actually get to pay them until 2021. So the general rule says that kind of a liability, you only deduct it when you pay it. Answer. Because refunds are payment liabilities, economic performance does not occur until he actually pays it. That's what I said. Consequently, Rick deducts the $800 in refunds in 2021, even though the liability for the refunds met the all events test in 2020. Because the general rule says you deduct it when you pay it. Under the cash method, he wouldn't deduct it until 2021 anyway. Now, let's take a look at a little different scenario. Suppose Rick received $800 of refund requests at year end. Under what conditions can he elect to deduct that in 2020, even though he didn't pay it? To claim this deduction under the recurring item exception, either that $800 cannot be a material amount, so it can't be a huge amount to Rick on his tax return, and he can better match revenues and expenses in the current year. Okay. Also, he actually has to pay that $800 by September 15th of 2021. So if he is going to pay that within 8.5 months of the end of the year, so middle of September, he meets the recurring item exception and he could deduct it in 2020, even though he didn't pay it. So there is that little snafu there that, this is when I meet economic performance, so that's when I get the deduction. If it's a recurring item, you may still be able to get the deduction. So crazy. So let's take a look at some more here. Ben assigned a binding contract for Peter to provide Ben with repair services. Ben paid $1,500 to Peter and owes an additional $6,000 on the contract. The repairs will commence late next year. Well, under the accrual method, Ben cannot deduct that until next year when economic performance occurs. That is our receiving goods or services from another. When can you deduct the payment to them? When they provide the product or service. Okay, so that was just a quick example. I don't think they don't have many more there. Wow, Penelope, I know you're kind of hanging there. Do you have any questions?
No, I don't have any questions.
Okay.
Yeah.
So the last slide or two deals with, can you change your accounting method? Sure. Okay, but you have to ask permission. And that's what this slide deals with. So you can go from an accrual to cash or cash to accrual, but you have to ask the IRS. Okay, I know that's the end of our presentation. I do want to talk about one last thing on page 9-27 before we wrap up. And I'm going to share my Word document again and talk about bad debt expense. And here's the rule. If a company sells on credit, and the customer doesn't pay them. Okay. Under the cash method, remember, you do not recognize income until you receive cash. So if you didn't receive income and show on your tax return, then you don't have a bad debt. So if you're a cash method taxpayer, no such thing as bad debt expense. Now, if you're sitting there going, well, wait a second, there was the money, right? There was the money, right? But since you never recognize that as income, oops, I see your little chat. Oh, okay, I didn't hear you, but thank you. The rule is this: no bad debt expense unless you showed that particular item in income. You can't take an expense for something you never showed as income. So cash method taxpayer does not show income until they actually receive it. So if you didn't receive it, you don't have any bad debt. Okay. Now, what if you're the accrual? Well, accrual method, a little different. Accrual method, as long as you showed the account that is bad in income in a tax year, a bad debt deduction can be taken when the account is actually bad. Let's put it that way, actually bad. So if you remember in intermediate accounting, we're going to be talking about it today, but in financial accounting, we estimate for bad debts and we record them as an expense, not when they happen, but when in the year we make the sales. No estimating in taxes. Taxes says no bad debt expense until you know you're not getting that money and it's an actual bad debt. And above and beyond that, you had to have shown that sale as income on your tax return. So essentially, bad debt expense will cancel out the income, so it's not taxed. And that's how we deal with bad debt expense. All right, so I think I'm out of time here. So I'm going to wrap up. Friday, when we meet again in person, I'm going to be talking about the Schedule C, the Schedule SE, and the qualified business income deduction. And then we'll be finished up and wrapped up with Chapter 9. So if you don't have anything, I will see you on Friday in tax, but I'll see you later in intermediate.